Going public as a corporation, creating stocks, and selling them. Chapter 1. Going public as a corporation. 1. Business prospectus to get investors. You have an idea or have started a business, so you write a prospectus not as in-depth as a business plan but more of a sales piece to try to get investors to put up money in exchange for a percentage of future profits. Find investors by advertising, making cold calls to rich people, pitching venture capitalists, etc. Set up a website where potential investors can go to see what you're talking about. In a regular company going public, you're selling thousands of shares. With this method, you may have from 1 to 25 investors who each buy a share or two. A prospectus is a 2 or 3 page letter describing the business idea, the costs of starting it, your bio and resume, your business strategy. Write it up. Start hustling, looking for investors. Some guy started a microbrewery. After about a year in business, he was looking to sell 20 shares at $5,000 each. He got the money in about a day from customers and other people he did business with. They saw the potential in the business. You have to decide how you will disperse future profits and write it out in a contract. Take your business public. 1. When your business is on the upswing, raise money on the stock market in order to achieve your goals. Going public means selling a part of the ownership of your company in the form of shares/stocks to the public in order to raise money. Going public is usually a twofold deal done to raise money for the company, pocket some wealth for yourself as the owner. The process basically goes through the following points. Find an underwriter, usually a stock brokerage firm. Put a prospectus together, the legal document you present to the Securities Commission. After some wrangling, you get approved. The underwriter decides on a course of action for the sale of stocks. They may time it to try to take advantage of the zeitgeist of the economy. They sell the stock, or at least try to take their cut. Then you're a public company who now has to follow the rules of the Securities Exchange Commission by coming out with regular corporate reports. If you own a private company, you may reach a point where loans are not enough to get you where you want to expand, so a public offering is the logical solution to get you the capital you need, provided you meet the stringent regulatory standards and you can find an underwriting brokerage firm to back you and sell your stock. Going public is seen as a symbolic advantage over being private in the business world because more people are involved and watching over your company, so if you can keep them all happy, you're a true winner as opposed to the tyrant running a private business. The major disadvantages of going public are that you have to play by stringent rules, maybe have some outsiders brought into your board of directors on the recommendation of your underwriting brokerage firm, you have to disclose everything in your quarterly and annual reports, run things on a tighter ship and play by the government's regulatory rules. Information about your company will be available to competitors, and the biggest disadvantage of all is that you will feel the pressure to perform by your stockholders and the scoreboard called the ticker, which will tell the world on a minute-by-minute basis how much you're winning or losing in the business game. In order to go public, you have to register with either the SEC/Securities Exchange Commission or your state authorities, then split the company up into shares/stock and offer it to the public for sale to invest in the company. A brokerage firm or investment banker is contracted by this corporation for a fee, generally 10% commission for stocks sold plus a startup cost, to manage the registration of the stock as well as the IPO/initial public offering and sale of it to public investors who become stockholders. They are called the underwriter. In order to offer a company up for public shares, first a prospectus must be written, then a large amount of legal paperwork must be generated as it's registered with either the federal SEC or your state securities department, or both, depending on what value you intend to place on your stock. The first step in preparing the registration statement is setting up a meeting of all key members of the registration team: attorneys, accountants, underwriter, chief officers of the company, board of the directors, anyone else relevant. This meeting starts the process of preparing the registration statement. Several preliminary tasks must be completed for the registration statement, such as the following: establishment of the basic business plan, Meetings of the Board of Directors to authorize the offering. Preparation and completion of the confidential questionnaire for the officers and directors. Due diligence. Legal research in order to comply with applicable state blue sky laws. Prepare the form to abide by the National Association of Securities Dealers/NASD rules. There are stringent restrictions regarding insider knowledge for the acquisition of these original shares. The original issue is sold as an IPO, initial public offering. Once all the stocks are sold and escrow is cleared, then trading on the stock starts, its performance based on how well the company is doing in the real world as a business venture. This registration process can take anywhere from 6 months to 2 years. The underwriting firm waits for the opportune time to make the IPO when they feel that conditions are right to maximize profits. They may find several other brokerage firms who will agree to sell the stock as well for a cut of the commission. Public offerings can be held in 3 ways. Intrastate, not regulated by the SEC but registered in the state where the company is located. The stock can only be offered to the residents of that state. Regulation A, relatively low legal costs and exemption from full registration. This is for small companies that need investment capital. The offering must not exceed $1.5 million. Shares must be registered by the SEC and can be sold in any state. Full registration, which is a tedious, complex procedure. Companies who undergo this procedure have 3 distribution options. The most common is the full commitment option, where the entire inventory of stocks is bought by the underwriting brokerage firm or group of brokerage firms and they try to sell it at the IPO at a profit, thus earning their money. The company executives who hold stocks could get immediately rich in the process. The company and underwriters agree at a price, say $10 per share. The underwriter buys it, then tries to sell it for $12 a share. If it sells for more, everybody makes money. If it tanks, everybody loses. The other 2 options apply mostly to registration companies which are speculative and shaky in nature with no proven track record. With the fixed commitment option, the underwriter finds other business investors to go in with them to share the risk. This group of companies is sometimes called an underwriting syndicate. The third option is called best effort, where the underwriter is not really confident in the companies, so they agree to sell the stock directly to the public without buying it themselves first. The underwriter tries to sell the new stock, but there's no guarantee on how much he can sell and when the offering will be completed, all stocks sold. Until the offering is complete, the stock cannot be traded publicly and the investor in limbo with his money. Sometimes there are hybrid full commitment best effort deals where the underwriter will buy a certain percentage of the stock and try to sell the rest on a best effort basis. Best effort all or none means that the underwriting broker has a certain time limit, usually 90 days or when he deems he's tried hard enough, to sell all the shares, otherwise the stock is rendered void and the money refunded to stock buyers. Usually sale of slightly less than all of the stock is considered acceptable, then actual trading begins after the IPO in what is called the secondary market after the initial sale of the fresh batch of stock. That's it in a nutshell, but of course it's considerably more complicated than that. If you want to go public, unless you have a proven private company with growth potential that's been operating at a profit for a few years, you could be wasting your time because the pool of underwriters, the business media and the investing public are way too savvy to bother much with risky IPOs from unproven companies. So the first rule is get your company off and running alone on its own 2 feet. Then when you're doing great, you can go public and get some investor money to expand operations. Secondly, if the market is bear and scared, put off your IPO until such time as the market is bullish and you can get a great media report about how fantastic your company is doing and how indispensable your products are. Even though the evidence shows that most IPOs decrease in value within the first year of trading, a lot of people are seduced by the idea of easy money and buy them. There will always be IPO buyers for a good solid company. The red tape with the state and federal regulations is exhaustive, but it may be worth it if you've got a good company ready to grow. Don't argue with your underwriter's suggestion of the IPO price. They know the business better than you. Their job is to sell stock, not yours. Although technically you can do your own public offering without the middleman, the underwriting brokerages are the experts and it could end up costing you more not to use them than give them the 10% commission or whatever it is you agree with them on. They're all about sales, selling stock, part of which is your stock, so without someone aggressively pushing your stock, you could be sunk before you've even started. Underwriters do a lot for their pay. They do a lot of paperwork and they're the upfront public sales people, so pick a good one or be good enough that they pick you when you send out your company prospectus looking for an underwriter. Unless you have contacts, the procedure is simple. Look in the phone book of any major city, particularly New York, because that's where all the stock market action is. Look in the yellow pages under brokerages and start soliciting for an underwriter. You can also find lists of brokerages in books and on the internet. Find a lawyer who specializes in this field and he will take care of it all for you. Underwriters generally purchase all of the stock in your offering at a fixed fee, say $10 per share, and sell it at $11 or $12, which is their spread, profit, commission, call it what you will. It's one way they make money. If they did their work well and people want the stock, the price will skyrocket and both they and the company owners/shareholders will make a lot of money fast, but according to SEC rules, they can't touch it until 6 months after the IPO. If the public thinks the company is a bomb, they won't buy the stock and both the underwriter and the corporation will lose money. If you decide to go public, find a list of recent IPOs in any investment magazine or newspaper, call or send a letter to their CEO. ipo.com/ipoinfo, ipodata.com, ipomaven.com, ipomonitor.com. Tell them you're the CEO of XYZ Corporation thinking of going public and ask if you can either meet in person or talk over the phone about the procedure regarding how to go public. High-level executives of different companies generally like to talk to each other, both to have friends in business and to learn from each other. Some underwriters specialize in certain fields. Through the grapevine, by asking people in the stock business, find the underwriters who specialize in your field. Just as the underwriter picks you, the better the reputation and the higher the profile of the underwriter you pick, the more money you will make. If you're a big company, try to get a major national underwriter to sponsor you. If you're small, look for an underwriter in your local area. Look under either brokerage houses or investment bankers in the yellow pages. You first come to an understanding with the underwriter through negotiations, make up a contract which is signed very near the time of the IPO. The basic tenets of the contract are: the underwriter agrees to manage the sale of the stock. The underwriter agrees to buy the stock from the company and resell it at a profit. The company agrees to disclose all its statements to the underwriter. The company agrees to pay all administrative costs connected to preparing for the sale of the stock. The company agrees to indemnify the underwriter against liability in case the company is perpetuating a fraud or provides misleading information. Some of the costs of going public are: administration fees, SEC registration fees, underwriter's commission, lawyer fees, accountant fees, state taxes and fees, travel costs to meet with underwriter, etc. Transfer agent fees. Miscellaneous. After the stock goes public, the company is responsible to the stockholders to send dividend checks if applicable, send quarterly reports, annual reports, notice of annual meeting, etc. Hold an annual stockholders meeting. You will have to hire a company attorney and accountant to do much of the paperwork with the underwriter and the SEC. You will have to decide whether to hire big city professionals skilled in these matters or local ones in your area. As for the stocks themselves, you and your underwriter have to determine the quantity of stocks you will issue and whether they will all be Class A common stocks or Class A and Class B, Class A being public and Class B being the preferred stock held only by a select few insiders, which has different voting rights and possibly different dividend rights than Class A stock. At the time of your IPO, you can grant stock buying privileges to your employees in either of two ways. Reserve a certain amount of stock that they have an exclusive right to buy. Offer them stock options to purchase stock. It's best not to push your employees to buy stock. Just offer it to them neutrally. That way if the stock goes up or down they can't blame you for either losing money or missing the opportunity. There are basically 3 exemptions from filing with the SEC. If you sell your stock through a private placement to only a few investors. If the value of the stock is less than a certain amount, $1,500,000 as of this writing. If it's an intrastate sale, the stock made available only to residents of your state, Section 3(a) 11 of the Securities Exchange Act of 1933. Press releases and advance publicity regarding the IPO is a very touchy subject with the SEC. You must wait until after the registration statement is filed and allowed to release only certain news relating to the company, so clear all press releases with your lawyer. Refer to Section 5(c) of the Securities Exchange Act. Just before your IPO, you're allowed to advertise as much as possible to get the word out. After your IPO, your stockholders will resell their portion of your stock, so you will need to hire a transfer agent and registrar to manage all these transactions as your stock is traded over and over again. You and the underwriter will have to select a board of directors. You will have to decide whether you pay out dividends or not, profit sharing every quarter by sending out checks to all your stockholders. If the stock value increases dramatically, you can do a stock split. After the IPO, the underwriter has done their job for the moment, but it's good to keep good relations for advice, a possible loan, or if you decide to sell more stock in the future. Under Section 13 and 15 of the SEC Act, you must file quarterly 10-K reports, annual 10-Q reports and periodic 8-K reports about the performance of the company. Your underwriter will advise you whether to sell your stock OTC, over the counter, or through an exchange. After you go public, security analysts and various aspects of the media will want to talk to you and research your company so they can rate you, put you in their books and talk about you on TV. The Society of Security Analysts may invite you to meet with them so you can learn about the investment business and they can learn about you, which they will pass on to the investment community. To qualify for the New York Stock Exchange, a company must have pre-tax earnings of at least $2.5 million, at least 1.1 million shares of common stocks outstanding with a market value of at least $18 million. To qualify for Amex, American Stock Exchange, a company must have either of the following: pre-tax earnings of at least $750,000. At least 500,000 shares of common stocks outstanding with a market value of at least $3 million. Or pre-tax earnings of at least $750,000. At least 250,000 shares of common stocks outstanding with a market value of at least $2.5 million. Below are just some of the stringent requirements a company must adhere to in filling out a full disclosure statement when going public to become an IPO. 1. The name of the issuer. 2. The name of the state or sovereign power under which the issuer is organized. 3. The location of the issuer's principal office. 4. The names and addresses of the directors and other senior officials. 5. The names and addresses of the underwriters, if any. 6. The names and addresses of persons owning 10% or more of any class of issuer's stock. 7. The quantities of securities owned by the directors, senior officials, underwriters, and 10% or greater holders. 8. The general character of the issuer's business. 9. A statement of the issuer's capitalization. 10. A statement of securities reserved for options outstanding, with names and addresses of persons allotted 10% or more of these options. 11. The amount of capital stock of each class included in the offer. 12. The issuer's funded debt. 13. The purposes to which the proceeds of this offering will be applied. 14. Remuneration payable to the issuers directly, naming them specifically when annual payments exceed $25,000. 15. The estimated net proceeds to be derived from the offering. 16. The price at which the public offering will be attempted. 17. Commissions, fees and so on, to be paid to the underwriters. 18. An itemized detail of expenses incurred by the issuer in connection with this offering. 19. The net proceeds derived from any securities sold by the issuer in the preceding 2 years and pertinent details of those sales. 20. Any consideration paid to a promoter in the preceding 2 years. 21. The names and addresses of any vendor of property or goodwill to be acquired with the proceeds of this offering. 22. Full particulars of any dealings between the issuer and its officers, directors, and holders of 10% or more of its stock that transpired in the preceding 2 years. 23. The names and addresses of counsel passing upon the legality of the issue. 24. The dates and details of material contracts created outside the issuer's ordinary course of business within the preceding 2 years. 25. Certified financial statements of any issuer or business to be acquired with proceeds of this offering. 26. A copy of the underwriting contract or agreement. 27. A copy of the law firm's written opinion attesting to the legality of the issue. 28. A copy of all material contracts referred to in item 24. 29. A copy of the issuer's charter, bylaws, trust agreement, partnership agreement, and so forth, as the case may be. 30. A copy of the underlying agreement or indenture affecting any security offered or to be offered by the issuer. Take your business public too. In order to go public, you have to find an underwriting financial services company that researches your company, then believes it can make money selling shares of it. It's not like the old days when it was relatively easy to get an underwriter just by having a .com name. These underwriters are looking for something safe they can make money from. If that's not you, look for another way for now. When your accountants and other people suggest you go public, that's the time to do it. You have to be growing, have good management and be in a good industry. A public company has to file a quarterly earnings report, which is a public domain document, to the Securities and Exchange Commission, SEC, every 3 months. If you have a good company, going public is the cheapest way to raise large amounts of money. The standard for going public is moved all the time. Check up on the latest rules. You have to present the underwriting company and future buyers of stock with solid-looking managers, particularly a CEO, CFO, and accountants. The IPO process is hard. The way to motivate managers is to offer them a good load of stock so they make money if the company makes money. Possible stock buyers want to see a company in a good industry that is expanding. Stock buyers are brutal. They won't go near certain industries. They have no loyalty. They will bail in a second on bad news. That means your company can be wiped out in a second too if the stock price goes way down. The National Association of Securities Dealers requires at least 3 independent directors on your board of directors. The SEC wants 3 years of audited financial statements to go public. They want a well-known firm to do this. Going public costs money and time. Several different teams have to agree before an IPO goes forward, like the company's management team, the company's attorneys, the company's accountants, the underwriters, investment bankers, the underwriters' attorneys, other advisors. Investment banks get fees plus a percentage commission of stocks sold. They try to hype it up with possible investors. Everything depends on the research analysis. The investment bank has one to research the new company. The media analysts report on IPOs and how successful they think they will be. Every IPO is different, but the common threads are: 1. Due diligence by the underwriters. 2. Registration of S1 with the SEC. 3. SEC review of the company. 4. Change the company or paperwork until the SEC is satisfied. 5. The prospectus is published and given to potential investors. 6. The roadshow, hyping the stock to institutional investors by doing presentations in the big cities for about 2 weeks. 7. The IPO. 8. How the stock develops. On the last day of the roadshow, the underwriters and the company negotiate the IPO price based upon the order book, the interest from institutional investors. An IPO that falls below its offering price is called a broken deal. They are often sued by lawyers who argue that they manipulated the price unfairly. Some underwriters are McDonald & Co., Merrill Lynch, Morgan Stanley, S.G. Cowen. Before going public, you, as the owner or executive of a company, must consider several important details before going public. It will be expensive to file the paperwork. Be ready for intense scrutiny from both your underwriter and the SEC. Be ready to file quarterly and annual reports to satisfy the SEC. Run the company impeccably. Will an underwriting firm consider my company solid enough to back me for a public stock offering, meaning will the public buy it? Will the cost of going public be worth it? It costs a significant amount of money. If I decide to go public, when will be the right time to do it? Do all the paperwork and get ready, but hold off until your company gets a good earnings report and the market is bullish, then do your IPO. Can I handle the public disclosure laws that mean I have to disclose virtually everything about the company? Look over the annual report that any public company has to fill out with the SEC and know you will have to do that too, not to mention all the initial scrutiny by your underwriting firm and the SEC at the outset. Can I handle the burden of being responsible to many stockholders and buy enough insurance to protect me in case the stockholders sue me? Is my company large enough? Check the current standards of the different stock exchanges through either them or the SEC to see what kind of worth and earnings you have to qualify for entry into their exchange. Will I lose control of my company to stockholders? Generally, you will only sell 49% of your stock to the public while keeping at least 51% for you and your allies. However, your stockholders will be watching you, hoping you do well and putting pressure on you when you screw up. You may have to add outside directors to your board of directors, you may not. It depends on your underwriters and what they want. Registration statement. Your registration statement is basically a detailed business plan/prospectus. Look over other companies' prospectuses in your field and use them as a guide in making up yours with your lawyer, underwriter, and accountant. The State Division of Corporations or the SEC will examine your registration statement, and once they declare it approved, you're on your way to your IPO. Even though you've filed a registration statement with the SEC, most states have blue sky laws where you have to register before you can sell stock in that state. For some states, it's a simple registration process. For others, you have to file a complete registration statement. You will have to have several meetings and set up a specific schedule of events. Send the SEC your registration statement as soon as possible because it may take some time for them to clear it. They may have several comments and deficiencies that you will have to clear up. If they find any deception, the SEC can impose either a stop order, injunction, or criminal penalties and civil liabilities. Refer to Section 8, D, 11, 12, 13 and 24 of the Securities Exchange Act of 1933 for more information. The general documents to be filed are: registration statement, prospectus, early draft, final draft, contract between company and underwriter, contract between primary underwriter and other underwriters, stock certificates made up. The registration statement is made up of two parts. The offering prospectus, which is a general information statement for investors, underwriters, bankers, etc. Additional information which is given directly to the SEC in order to conform with disclosure and registration regulations. The registration statement is part of the public record and is open to anyone from the public who wants to look at it: journalists, investors, housewives, etc. There are a variety of different forms that can be used as the registration statement dependent on such things as size of company, company history, type of public offering. The most common form is Form S1, which is quite complicated, having a number of requirements that must be fulfilled before going public as well as a detailed plan of how the company operates. Forms S2 and S3 are used by companies that are already subject to the reporting requirements of the Securities Exchange Act. Form S4 is used for certain types of corporations. Forms S1 through S4 are processed through the SEC at sec.gov by the Division of Corporate Finance. Follow the SEC guidelines for filling out your registration statement. The major facets of the registration statement are as follows: cover page and forepart. Summary information about the nature of the company's business, terms of the offering, determination of the offering price, dilution, plan of distribution, risk factors, and basic financial information. Introduction to the company. Nature of the business, employees, financial performance, and location of principal offices. Risk factors. Risks and weaknesses of the company. Do you rely on one supplier, one major customer? What is the history of performance? Is it a new industry? Why do you think it will succeed? Use of the money raised. What will you use it for? Capital structure, financial information, business, and property of the company. Describe them all with some detail. Provide a biography of all members of the management and a list of names of any investor who owns 5% or more of the company. Provide a brief biography of the people on your team, the accountants, lawyers, etc. Give the details of any litigation or legal-related matters past, present or anticipated that is relevant. Describe the underwriting arrangements to sell the stock. Other things, namely, the history of the company. Restricted securities. All shares of a public company held by its controlling members like its officers, directors, and 10+% shareholders are classified as restricted securities under the Securities Act. The sale of restricted securities is governed by Rule 144, which has following requirements as a condition of sale. The company must make its required current periodic reports to the SEC. The restricted securities must have been owned for at least 1 year preceding the sale. The amount of securities that may be sold in any 3-month period must be limited to 1% of the outstanding class of securities or to the average weekly reported volume of trading in the securities on a registered national security exchange, if the securities are listed, whichever figure is greater. The securities must be sold only in brokers' transactions, and the notice of the sale must be filed with the SEC concurrently with the placing of the sale order. If the sale involves 500 shares or $10,000, a report of the transaction on Form 144 must be filed. IRC 1244 stock. An experienced business consultant can fill you in on the 1244 stock advantages. Getting eligibility for the 1244 stock category is a very simple process but one with benefits to your business. The 1244 status encourages investors to put equity capital into your business because in the event of a loss, amounts up to the entire sum of the investment can be written off on taxes in the current year. Without the 1244 classification, any losses would have to be spread over several years and this would greatly lessen the attractiveness of your company's stock. Any business owner who has not filed the 1244 corporation has in effect cut himself off from 90% of his prospective investors. At the time of the first meeting of the corporate board of directors and prior to issuance of any shares, you might consider adoption of the IRC 1244 plan that grants ordinary rather than capital treatment of losses on certain small business stock. Among the requirements of qualification as Section 1224 stock are: 1. The stock must be common stock. 2. The stock must be issued by the corporation for money or other property pursuant to a written plan containing several limitations. 3. The amount of contribution received for the stock and equity capital of the corporation must not exceed maximum dollar limits. Small business initiatives. In 1992, the SEC started the Small Business Initiatives, SBIs, in order to give small businesses the chance to go public without the hassles of a full-fledged registration process, thereby thus able to earn investment money and hopefully grow. Its special provisions for offerings by small businesses is included in Regulation SB. A small business issuer, as defined in Rule 405 of the Securities Act of 1933, the Securities Act, is a company which meets all of the following criteria. Has revenue of less than $25 million. Is a United States or Canadian issuer. Is not an investment company. If a majority-owned subsidiary, has a parent corporation that is also a small business issuer. Small business issuers can use Form SB1 or Form SB2 to register with the SEC. With Form SB1, a company can only register up to $10 million of securities. Furthermore, the company must not have registered more than $10 million in any continuous 12-month period, including the transaction being registered. Form SB2 allows small business issuers to offer an unlimited dollar amount of securities. So what this means is that if you meet all the criteria to be classified as an SBI, you're allowed to sell more securities at some later point in time after you've grown and expanded without having to undergo the same extensive disclosure process as larger companies who register through Form S1. The advantages of Form SB2 are: you can raise more money as you need it. Filing with either one of the SEC's regional office or its headquarters office in Washington, D.C. It's much cheaper process to file an SB1 rather than S1. Private placement offerings, PPOs, / the unlisted securities market. Another type of stock offering that's not public is called private placement, generally for small companies, where you divide your company into stock and sell a portion of it to less than 76 investors who sign a contract saying they won't resell them. Private placement doesn't have to be registered with the SEC. Private placement offerings / PPOs are a company's offer of shares to investors in order to raise capital. Small companies or new companies use PPOs to raise money because it's much simpler and more convenient than going public by registering with the SEC, but there are limits on how much money you can raise, which is currently around $1 million, but this limit is changing all the time. While private placements can be handled directly by the company and its few investors, most are handled by underwriting brokers who sell the shares to investment funds, financial institutions, pension funds, insurance companies, etc. The unlisted securities market allows your company to go public whilst only making as little as 10% of the capital available to shareholders. The 5 years of records that are required to become fully listed on the stock exchange are not needed. If you operate as a sole trader or as a partner, you and your partners, where applicable, are personally responsible for all the debts and other liabilities of your business. If your business was to fail with large debts, you could end up having personal property taken from you by court order, even losing your home if it were required to satisfy large debts. With partnerships, partners are jointly liable, so each of you is responsible for any of the debts created by any of the other partners. It is possible for a partner to run off with the assets and leave the remaining partners to suffer the consequences. PPOs are regulated by both state and federal laws. Learn the procedure for your state, get competent accounting and legal assistance, and proceed from there. By Section 5 of the Securities Act of 1933, you must file a registration statement with the SEC before you offer to sell securities, shares, in interstate commerce unless you are exempt via the provisions of Sections 3 and 4 of the Act. Registration under Section 5 is time-consuming, tedious, and expensive. The most common exemption is the private placement offering. Working with your legal counsel, you must form your PPC according to the tenets of Registration D. Section 3, A, 11, Intrastate Exemption. Section 4, 2, Private Offering Exemption. For Regulation D, a company can choose from among Rule 504, 505 and 506 to determine how much money you can raise per 12-month period and other conditions of investment. Federally, Rule 501A covers the categories of investors you're allowed to get. Most states use the Small Corporate Offering Registration /Score, which, in accord with Form J7, makes it easier to comply with the federal Regulation D. As a business owner, your job is to prepare a private placement memorandum /PPM with your lawyer, which is essentially a business plan. Submit it to the proper state and federal authorities, wait for either rejection or approval and proceed from there. If rejected, fix what they want you to fix and try to get it approved again. Insider trading. The SEC's Rule I0b5 covers insider trading cases, the text of which is as follows. It shall be unlawful for any person, directly or indirectly, by the use of any means or instrumentality of interstate commerce, or of the mails or of any facility of any national securities exchange. 2. A. Employ any device, scheme, or artifice to defraud. B. Make any untrue statement of a material fact or omit to state a material fact necessary in order to make the statements made, in light of the circumstances under which they were made, not misleading, or C. Engage in any act, practice, or course of business which operates or would operate as a fraud or deceit upon any person, in connection with the purchase or sale of any security. The most common type of insider trading is a case where an officer, director, or other person who is involved with a corporation buys or sells the company's securities while in the possession of material, non-public information, but Rule L0b5 is not limited to just this scenario. Some other possible instances of insider trading are as follows. A corporation either issues misleading information to the public or omits stating information it is obligated to disclose. When an insider tells a friend or ally some material, non-public information who uses it to trade securities, a process called tipping, which was the basis of the Martha Stewart case. General manipulation of stock prices by company insiders in any of a number of ways. General manipulative behavior by stockbrokers and other securities sellers. Selling bonds as a corporation. Businesses can sell bonds, fixed interest payments securities, on themselves to earn money. There are many rules for it. Refer to sec.gov. Chapter 2. Going public as a corporation. 2. Initial public offerings/IPOs. When commissions were deregulated May 1, 1975, the brokerage houses lost their major source of income as commissions went way down. They had to look for another source of income. In the 80s, it was mergers and acquisitions, but in the 90s, with the internet producing new companies making incredible IPOs, Netscape.com, TheGlobe.com, Drugstore.com, Cashflow.com, Priceline.com, eBay.com, the underwriters were getting commissions of about 7%, so they went nuts, aggressively looking for anything that could pass for an IPO, even though many of these companies were barely more than a business plan with no assets, no track record and no proven performance. There were 4,700 IPOs in the 90s, then the bubble burst. They got their commissions regardless, while most of the public stock buyers lost a lot of money because of all the hype by these brokerage firms promoting what were obviously dummy companies with nothing going for them. The lesson is: be smart. IPOs are usually duds unless it's a private company that's been around a while and is just now going public. You probably can't get in on the first run of most IPOs anyway. The brokerages offer them to their institutional investor buddies first, they buy a bunch and either sell them later on in the first day of the IPO to make a handsome profit, or wait a day or two then sell once the IPO is all hyped up and selling to the public. This is called flipping and it's very common. You can't beat the people on the inside. They're setting you up every time with their hyped up IPOs. All these insiders got their profits, so they don't care what happens when the IPO is dumped onto the public. I say stay away from IPOs unless you know for sure it's a proven company. Many new initial public offerings, IPOs, increase drastically in the first month but 40% decrease in value within the first year. Do your homework. Don't invest unless you can get in dirt cheap in the first week, then sell after the initial onslaught, or if you know for sure the company's going places. Check with the seconds to see if the underwriter has any complaints against him. In my opinion, IPOs are too risky to bother with unless you know something for sure. For the OTC market, most new issues are overpriced and will go down. Buy with the target of selling at any time at a profit. Check out the auditors and underwriters in the prospectuses of OTC stocks with the seconds to see if they have ever had complaints against them. Ask if they have plans to move into Nasdaq. If they do cross over, your stock will rise in value. Check the following newsletters for information about new offerings. If you want to get into IPOs, find an underwriting brokerage firm that handles IPOs, find a broker in there, become a good client with him, and then he might let you in on the primary sales phase of the IPO. By law, the brokerage firms are allowed to freely advertise their general services as brokers, but when it comes to an IPO, all that they're allowed to do is to place a brief ad in the financial on the day of the news called a tombstone, which is kind of ridiculous since by the time the average investor sees this IPO of a good company, all the shares have been long sold, which is why it's all about contacts when it comes to making money in stocks, or meticulous reading where you learn about IPOs in advance from journalists in the know. IPOs are frequently sold in two phases. A primary phase to institutional investors and good clients. A secondary phase to the general public. Don't buy new public offerings because they're probably overpriced and you have no background to judge them. Watch them for a few months to see what they do. The risks are too high that it could bust unless you know it's a good company. Most IPOs aren't worth it. Below are just some of the stringent requirements a company must adhere to in filling out a full disclosure statement when going public to become an IPO. 1. The name of the issuer. 2. The name of the state or sovereign power under which the issuer is organized. 3. The location of the issuer's principal office. 4. The names and addresses of the directors and other senior officials. 5. The names and addresses of the underwriters, if any. 6. The names and addresses of persons owning 10% or more of any class of issuer's stock. 7. The quantities of securities owned by the directors, senior officials, underwriters, and 10% or greater holders. 8. The general character of the issuer's business. 9. A statement of the issuer's capitalization. 10. A statement of securities reserved for options outstanding, with names and addresses of persons allotted 10% or more of these options. 11. The amount of capital stock of each class included in the offer. 12. The issuer's funded debt. 13. The purposes to which the proceeds of this offering will be applied. 14. Remuneration payable to the issuers directly, naming them specifically when annual payments exceed $25,000. 15. The estimated net proceeds to be derived from the offering. 16. The price at which the public offering will be attempted. 17. Commissions, fees and so on, to be paid to the underwriters. 18. An itemized detail of expenses incurred by the issuer in connection with this offering. 19. The net proceeds derived from any securities sold by the issuer in the preceding 2 years and pertinent details of those sales. 20. Any consideration paid to a promoter in the preceding 2 years. 21. The names and addresses of any vendor of property or goodwill to be acquired with the proceeds of this offering. 22. Full particulars of any dealings between the issuer and its officers, directors, and holders of 10% or more of its stock that transpired in the preceding 2 years. 23. The names and addresses of counsel passing upon the legality of the issue. 24. The dates and details of material contracts created outside the issuer's ordinary course of business within the preceding 2 years. 25. Certified financial statements of any issuer or business to be acquired with proceeds of this offering. 26. A copy of the underwriting contract or agreement. 27. A copy of the law firm's written opinion attesting to the legality of the issue. 28. A copy of all material contracts referred to in item 24. 29. A copy of the issuer's charter, bylaws, trust agreement, partnership agreement, and so forth, as the case may be. 30. A copy of the underlying agreement or indenture affecting any security offered or to be offered by the issuer. Going public websites: ipo.com, sec.gov, busop1.com/howto.html, tcc5.com, allbusiness.com, answers.com/topic/initial-public-offering, artfieldinvestments.com, business.com/directory/financial_banking_and/sales_and/brokerage/sales_public_offerings_IPO. businessownersideacafe.com/financing/ipo.php, capbay.com, compliancematters.com, gopublic-freinfo.com, gopublictoday.com, gopublicusa.com, iposhells.com, maist.com, helps companies wanting to go public. Direct public offering websites. Entrepreneur.com/money/how-to-guide/article 52818.html. dpocentral.com. dpo-council.org. IPO websites. 123jump.com/IPO Maven. alertipo.com. directipo.com. direct-stock-market.com. directstockmarket.com. dsm.com. dsr.simplenet.com/eod. edgaronline.com/IPO Express. e-iponet.com. eoffering.com. fbr.com, 888-200-4350. fortmyers.com/ipo/epoem.html. gaskinco.com. hemscott.com. hoovers.com/ipo/guide. hoovers.com/ipo. interbourse.com. inetcapital.com. investhelp.com. investinipos.com. investquest.com. ipo.com. ipocentral.hoovers.com. ipocentral.com. ipodata.com. epoem.com. iposyndicate.com. ipoexchange.com. ipoinsight.com. ipomonitor.com. ipo-network.com. ipo.investcom.com. ipomaven.com. ipodirect.com. linux.agsm.ukla.edu/ipoinside/ipoinsideaccess.html. moneypages.com/syndicate/stocks/ipo.html. nestegg.iddis.com/ipo. netresource.com.